Forex trading, or foreign exchange trading, is the practice of buying and selling currencies to profit from fluctuations in exchange rates. As the world's largest financial market with a daily trading volume exceeding $6 trillion, it's a highly dynamic and potentially lucrative endeavor. But given its complexity and the varying regulations across different countries, a crucial question arises: is Forex trading illegal? The answer isn't straightforward, as the legality of Forex trading depends on where you live and the regulatory environment of that region. Let's explore this topic in detail. Understanding Forex trading. To grasp the legal nuances, it's important first to understand how Forex trading works. Unlike stock markets, where you trade shares of companies, Forex trading involves the exchange of one currency for another. For example, you might exchange US dollars, USD, for euros, EUR, speculating that the euro will strengthen against the dollar. The Forex market is decentralized, meaning it doesn't have a central exchange like the New York Stock Exchange. Instead, trading takes place over the counter, OTC, through a global network of banks, brokers, and financial institutions. This decentralized nature allows the Forex market to operate 24 hours a day, 5 days a week across different time zones. The legal landscape around the world. The legality of Forex trading varies significantly from one country to another, shaped by each nation's regulatory framework, financial market conditions, and even cultural attitudes towards speculative trading. United States. In the United States, Forex trading is legal but highly regulated. The Commodity Futures Trading Commission, CFTC, and the National Futures Association, NFA, are the primary regulatory bodies overseeing Forex trading activities. The CFTC enforces rules that protect traders from fraud and manipulation, while the NFA ensures that brokers adhere to strict standards of conduct and transparency. U.S. regulations require Forex brokers to register with these bodies, meet minimum capital requirements, and follow strict reporting and auditing procedures. The stringent regulations are designed to provide a high level of protection to retail traders, although they can also limit some trading options, such as the amount of leverage available. European Union. In the European Union, Forex trading is also legal and subject to rigorous regulation, largely overseen by the European Securities and Markets Authority, ESMA. ESMA sets guidelines and rules that apply across all EU member states. The local regulators in each country may impose additional rules. One of ESMA's significant regulatory measures is the limitation on leverage, which caps the amount of borrowed funds a trader can use. This is intended to reduce the risk of significant losses among retail traders. Brokers operating in the EU are required to be transparent about the risks of Forex trading, ensure that client funds are segregated from their own, and adhere to strict advertising standards. Australia. Australia is another major hub for Forex trading, where it is fully legal and regulated by the Australian Securities and Investments Commission, ASIC. ASIC is known for its stringent regulatory approach, which includes ensuring that brokers maintain high operational standards and provide clear and accurate information to their clients. Australian Forex brokers must also keep client funds in segregated accounts, protecting traders' capital in case the broker faces financial difficulties. ASIC's regulations are designed to foster a fair trading environment, protect traders from unethical practices, and maintain the integrity of the financial markets. Asia. In Asia, the legal landscape for Forex trading is diverse. Japan, for instance, has one of the most developed and strictly regulated Forex markets in the world. The Financial Services Agency, FSA, oversees the market, enforcing regulations that include leverage limits, mandatory registration for brokers, and strict reporting requirements. Similarly, Singapore's Forex market is well regulated by the Monetary Authority of Singapore, MAS, which ensures that the market operates efficiently and transparently. On the other hand, China presents a more complex scenario. While Forex trading is not outright illegal, it is heavily restricted. The Chinese government imposes strict controls on currency exchange and capital outflows, making it challenging for residents to engage in Forex trading. Offshore Forex brokers often face difficulties operating in China due to these restrictions, and many Chinese traders turn to unregulated or offshore platforms, which carry significant risks. Middle East. In the Middle East, the regulatory environment for Forex trading differs significantly across countries, reflecting a complex interplay of financial, cultural, and religious factors. The United Arab Emirates, UAE, stands out as a beacon of Forex trading activity, particularly in Dubai, which has evolved into a global financial hub. The UAE's regulatory framework is robust and well-defined, overseen by the Dubai Financial Services Authority, DFSA, and the Central Bank of the UAE. These regulatory bodies ensure that Forex brokers adhere to stringent standards, including transparency, financial stability, and investor protection, thereby fostering a secure trading environment. Its clarity and structure attract international investors and traders, contributing to Dubai's reputation as a major forex trading center. In contrast, other Middle Eastern countries often exhibit more restrictive or ambiguous regulatory stances towards forex trading. This can be attributed to cultural and religious factors that influence financial practices. In some regions, religious prohibitions against certain forms of financial speculation or the lack of a clearly defined regulatory framework can lead to uncertainty and potential challenges for traders. As a result, potential forex traders in these areas may face obstacles such as limited access to trading platforms, a lack of regulatory oversight, or an ambiguous legal environment, which can deter participation in the forex market. This divergence in regulatory approaches underscores the need for traders to thoroughly research and understand the specific regulations and cultural considerations in their country of interest before engaging in forex trading. The risks of unregulated forex markets. Forex trading is legal in many parts of the world. Nonetheless, it is impossible to ignore the dangers that are associated with markets that are either not regulated at all or are only partially regulated. Unregulated brokers who frequently operate from locations with low regulation are able to engage in unethical actions such as manipulating pricing, refusing to process withdrawals, or even disappearing with the funds of their clients. Because of this, it is extremely important to select a broker that is regulated by a respectable body, regardless of the location from which you are dealing in financial transactions. The fact that unregulated markets provide traders with very little to no protection in the event of disputes or broker insolvency is another important difficulty that they face from these marketplaces. There is a possibility that traders in these markets will be subjected to unjust trading conditions such as hefty fees, large spreads, or exaggerated promises of big returns. Some traders may not even be aware that they are working with an unregulated broker until they experience problems. By that point, it may be too late to retrieve their cash. This is because the unregulated broker is not subject to any regulations. Key considerations for safe forex trading. To trade forex safely, it's vital to be aware of the legal framework in your country and to choose a broker that is properly regulated. Researching and understanding local laws is essential, as they can vary significantly even within regions. Additionally, staying informed about any updates or changes in regulations can help you remain compliant and protect your investments. It's also important to recognize the risks associated with leverage, a common feature in forex trading. While leverage allows you to control a large position with a relatively small amount of capital, it also magnifies potential losses. Many regulatory bodies impose limits on leverage to protect traders, but in unregulated markets, these limits may be absent, increasing the risk of substantial financial loss. Finally, always be cautious of brokers that make unrealistic promises or use high-pressure sales tactics. If something seems too good to be true, it probably is. A legitimate broker will be transparent about the risks involved in forex trading and will not guarantee profits or success. Conclusion. Forex trading is legal in many parts of the world, but the key to trading safely lies in understanding and adhering to local regulations. Whether you're trading in the highly regulated markets of the US and the EU or navigating the more complex legal landscapes of Asia and the Middle East, choosing a reputable, regulated broker is crucial. By staying informed and cautious, you can protect yourself from the risks associated with forex trading and potentially enjoy the rewards of this exciting financial market. Happy trading. Thanks for watching. Don't forget to like and subscribe to our YouTube channel.